Welcome to Wealth and Means, advice dressed up like hard work. Thank you to our new listeners from Vietnam, Singapore, Iraq, Denmark, the United Kingdom, Germany, Ecuador, India, and the United States. Let's get into it.
This week, we're looking at the friction points where attention and opportunity misalign. We've got emerging AI architectures that flip the energy equation on its head, more efficient and more accurate at the same time, which shouldn't be possible, but is. We're watching tokenization scale faster than the financial system expected. The creator economy just rewired itself in one software update. Pakistan somehow moved from the periphery to the center of the biggest geopolitical negotiation in years. And there's a bond hiding in the tax code that's been there for 100 years that most high-income earners are using badly or not at all. In the knowledge bomb, we're getting into tax-free municipal bonds and the math that makes them more powerful than they look. Humor Me has some thoughts on the gap between going to the moon and building a train in California. The Greater Debate features Neil Howe and Bobby Duffy on whether generational theory is a useful lens or a harmful myth. And in Let's Invent Again, we're going back to 1841 and the man who replaced rules of thumb with mathematics, Squire Whipple. Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee. A quick thank you to our sponsor, agentweekly.ai, chronicling the absurd, the ambitious, and the algorithmically challenged corners of the AI agent economy. First, let's begin with what you didn't see in the news. Let's start with something that feels like it shouldn't work, but does. Researchers just demonstrated that you can cut AI energy use by up to 100 times while actually improving accuracy. The method? Neurosymbolic AI. Basically, teach the neural network to think in steps, the way a human does. Break the problem into categories, reason through causality, then let the machine do what it does best. The kicker? It needs way less real-world data to adapt to situations it's never seen before.
That's the inverse of every AI trend we've been tracking. More efficient and smarter at the same time.
Exactly. Meanwhile, in robotics, there's a quiet revolution happening around world models. These are AI systems that understand physics, cause and effect, object permanence, momentum. Robots trained on these models need dramatically less physical trial and error to operate in new environments. NVIDIA's National Robotics Week coverage this month is basically saying, this is the year reliable embodied AI stops being theoretical.
So the compute problem gets cheaper and the reasoning problem gets clearer.
In the creator economy, Instagram just rewired the entire incentive structure. They've rolled out native affiliate links directly in Reels. Brands can now see which Reels drove clicks and which drove actual purchases, all inside Meta. No more routing through third-party attribution tools.
That's a fundamental shift from reach to revenue.
And it's exposed something interesting. Follower count is basically worthless as a casting metric now. The gap between micro-creators in hyper-specific niches and mass-reach creators is widening. Customer-turned creators who actually use the product beat influencers with 1 million followers. Trust converted to sales, not attention converted to sales.
Niche depth over mass reach, that's a first principles reset.
In crypto, the decentralized AI boom is the story right now. The argument's compelling. Centralized AI entities are data monopolies, so capital's flooding toward decentralized alternatives, what they're calling DAI. It's the most significant sector momentum in April 2026. Real-world asset tokenization on Ethereum is another piece of that. Treasury tokenization, real estate, private equity, it's hit $20 billion on layer 2s. BlackRock and JP Morgan are settling secondary trades on Ethereum now.
The infrastructure's getting serious.
On the geopolitical front, the Iran-US ceasefire talks moved from back channels to Islamabad this week. Vice President Vance is leading a high-level delegation. But here's what's counterintuitive. Pakistan, which wasn't at the table for the 2015 nuclear deal or the Abraham Accords, is now the center of gravity. They brokered the 2-week ceasefire and convinced both sides to talk. It's a diplomatic repositioning that nobody saw coming 6 months ago.
Power and influence don't move in straight lines.
In space, NASA's Artemis II crew just passed the record for farthest human spaceflight, surpassing Apollo 13's distance from Earth. Reed Wiseman, Victor Glover, Christina Koch, and Jeremy Hansen traveled 248,000 miles from home. They've got high-resolution imagery of the moon's far side, and a photo of the moon eclipsing the sun. They splashed down successfully off San Diego.
Welcome back to Earth. That's the kind of thing that reminds you what we're actually capable of.
On the wellness side, something's shifting. There's a growing backlash against over-optimized health tracking. People are fatigued by the measurement culture, the constant data, the optimization, the self-surveillance. The next wave of wellness is moving toward meaning, not metrics. Catharsis, not clinical data. It's a philosophy shift hidden in product design.
The pendulum swinging back toward being human.
And one last piece. The Solarpunk subreddit just hit 1.7 million members. It's a sci-fi community focused on optimistic futures and sustainable solutions. It's growing quietly, driven by Gen Z looking for narratives that don't end in collapse. That's a signal. People are building intellectual safe havens around the futures they want to see. Now let's wake up ready. Let's get into what's coming next week and the one after. The macro weather report you need to be watching. First up, the April PCE report drops on April 30th. That's going to tell us whether the Fed's thinking about rate cuts or holding steady. PCE is the inflation gauge they actually watch. The market's been pricing in one rate cut by mid-year, but if PCE shows persistence, that expectation gets repriced. Expect volatility.
The inflation door's not fully closed.
April 16th, we've got advanced retail sales and Philadelphia Fed manufacturing survey landing the same day. Retail drives 30% of GDP. Manufacturing survey tells you about the production side. Together, they'll either confirm economic resilience or hint at weakness. The dollar's strong right now, and that's headwind for exporters. Watch the divergence between domestic strength and external vulnerability.
Growth and currency matter differently depending where you're exposed.
Jobless claims are weekly releases. April 9th, 16th, 23rd, 30th. They've been stable around 215,000. A spike above 230 would be a signal. Quiet warning, the labor market hasn't cracked yet, but the trend matters more than the level.
Employment's the lag, not the lead.
Fed minutes release on April 16th. Whatever they said in the March meeting gets clarified or confused, depending on how you read it. There's always a tell in the minutes about what they're debating that didn't show up in the statement. Watch for language around financial conditions and whether they think the market's pricing in cuts too aggressively.
The Fed's thinking aloud, and that shapes everyone else's thinking.
All right, let's talk about the tectonic shift in the markets this morning. If you thought the IPO window was just cracking open, Elon Musk just smashed it with a Falcon 9. SpaceX has officially filed, and after years of will they, won't they, the S1 is hitting the desk with a valuation target of $1.75 trillion. To put that in perspective, we are looking at the largest IPO in human history. But it's the strategy that's really turning heads. Musk is running what we're calling the retail playbook. Instead of just letting institutional whales feast, SpaceX is earmarking a massive chunk of shares specifically for retail investors. They're even hosting 1,500 everyday traders at a major event on June 11th. Mark your calendars, because the roadshow kicks off the week of June 8th, which puts the official listing date somewhere in late June or early July. If you're digging through EDGAR filings, keep an eye on SpaceX-linked entities like Spear and HII Series 2, which are already moving parts behind the scenes to manage private share distributions. But it's not just a one-man show. April is rapidly becoming the month of AI infrastructure. On April 16th, we're watching Madison Air Solutions, which is looking to raise over $2 billion just to keep the world's AI data centers from melting down. Arxis is hitting the tape the same day with a billion-dollar aerospace play, and we just saw a fresh filing from the Blackstone-backed event giant Encore, which is eyeing a major move toward the NYSE. From the stars down to the server racks, the AI ripple is dominating the tape. Whether it's space-based intelligence or cooling the cloud, the smart money is betting on the bones of the next economy.
Dry powder moves when confidence thaws.
Here's my personal watch for the week. LinkedIn is releasing updated employment trend data. I know that sounds boring, but LinkedIn has 800 million professionals globally, and they're tracking job postings, hiring rates by industry, and wage pressures in real time. If you're watching the labor market's future, not its past, that data is more predictive than the monthly jobs report. Watch their April data for weakness in enterprise spending on hiring. That's the real leading indicator nobody talks about.
And that is how you wake up ready. Let's talk about one of the cleanest advantages in personal finance. Not because it's secret, It's been in the tax code for over 100 years, but because most people either don't know how to value it or they don't know it applies to them. Time for the knowledge bomb. Here's the setup. You need a new bridge. Not you personally. Your city does, or your county. They need to fund a school, a water treatment plant, a commuter rail connection. The city can't just run up a credit card. They issue bonds, debt, same as any company would. You buy the bond, they pay you interest over 10 or 20 years, and at maturity they return your principal. Standard mechanics. Now here's the part that changes the math. The federal government has decided, for over a century, that the interest income from these municipal bonds is exempt from federal income tax. If the bond was issued in your state, most states exempt it from state taxes too, and in certain jurisdictions, from local taxes as well. Triple exempt. You earn interest, and the government takes nothing. The technical name is tax equivalent yield, and this is where it gets interesting. Say a municipal bond is offering 3.5%. That sounds modest, but if you're in the 40% federal tax bracket, you'd need a taxable investment yielding 5.8% just to match it after taxes. The formula is simple. Divide the muni yield by 1 minus your marginal rate. At the 40% bracket, 3.5 becomes 5.8. At 42%, it becomes 6%. The higher your income, the more powerful this becomes. Why does the federal government give this exemption? It's not altruism. It lowers borrowing costs for state and local governments. Municipalities can offer lower rates because their investors keep more of the yield. The tax exemption is effectively a federal subsidy for local infrastructure delivered through the private bond market. The current context matters. With government deficits pushing up treasury yields and municipalities across the country issuing new debt to fund aging infrastructure, the supply of munis is expanding. For high-income earners, the after-tax yield spread between munis and treasuries is among the widest it's been in years, which means the advantage hasn't gone away. It's gotten more pronounced. There's one wrinkle worth knowing. Not all municipal bonds are created equal. Some have AMT exposure. Some are revenue bonds, backed by specific project cash flows rather than general obligation bonds, backed by the full taxing power of the issuing government. Credit risk exists. Puerto Rico's municipal bonds defaulted in 2016. Illinois has had downgrades. Homework matters. But for the high-income earner who's been sitting in a fully taxable bond portfolio, the first question isn't, are munis safer? It's, what's my after-tax yield at my actual marginal rate? Because very often the answer is more than you thought. And that's the knowledge bomb.
This week, NASA sent 4 human beings 248,000 miles from Earth, around the moon, through the lunar night, back through the atmosphere at 25,000 miles per hour, and safely into the Pacific Ocean. The whole trip, 10 days. The mission was called Artemis II, and it launched on April 1st, April Fool's Day. That's not a joke, that's just good scheduling. Humor me. Meanwhile, California has been building a high-speed train. The Bullet Train, officially the California High-Speed Rail Project, was approved by voters in November 2008, 17 years ago. The original budget was $33 billion. The current estimated cost, depending on who you ask and how optimistic they're feeling that day, is somewhere between $100 and $128 billion. For scale, NASA's entire Artemis program, including designing a new rocket from scratch, building a lunar capsule, and actually going to the moon, costs roughly $93 billion over its full life cycle. As of today, no passenger trains are running on the California Bullet Train. The first segment, a 119-mile stretch through the Central Valley, which nobody asked to be the first stretch, is still under construction. The full San Francisco to Los Angeles route, expected completion is now sometime in the 2030s. Maybe. So just to recap, NASA launched on April Fool's Day, went to the moon, broke the farthest human spaceflight record, photographed the far side of the lunar surface, and splashed down safely in the Pacific. California is still working on Fresno. To be fair to California, space is easier because nobody's trying to build through Bakersfield.
There are debates that stop your reel, and there are the debates that linger long after the dinner plates are cleared. It's time for the greater debate. Imagine a room, 2 lecterns, no moderator, no slides, just a whiteboard behind them, half erased, like someone tried to diagram time and gave up halfway through. Neil Howe steps forward first, not rushed, not theatrical, certain. He doesn't open with a definition. He opens with a claim. History has a rhythm. not metaphorically, structurally, 80 to 100 years, a full cycle of human life, birth to death, and then it repeats, not exactly, but recognizably. 4 turnings, 4 moods, each generation shaped by the one before it, each one leaving behind the conditions for the next. Pause, he lets that sit. We are not as unique as we think we are. There's a ripple in the room, some agreement, some resistance. At the other lectern, Bobby Duffy doesn't step forward. He leans in slightly, like he's about to correct a number that's off by just enough to matter. Or, we are exactly as predictable as we've always been. Now the room shifts. Duffy doesn't attack the cycle. He reframes the question. When you say generation, what do you actually mean? He gestures, not wide, not dramatic, just enough to mark the categories. Age effects, period effects, cohort effects. Young people behave like young people, always have, always will, risk-seeking, identity-forming, undercapitalized. That's not a generational trait. That's being 22. Few nods, familiar ground. And when something big happens, a war, a financial crisis, a pandemic, everyone moves together. Beliefs shift across all ages. That's not generational either. That's history hitting the system. He lets the implication land. So what's left? Silence, not empty this time, tight. Howe doesn't respond immediately. He writes something on the whiteboard instead. 4 words, stacked. Prophet, nomad, hero, artist. He turns back. What's left is structure. Now the tension is visible. You can explain away behavior at a moment in time, he says, but you can't explain away patterns across centuries with coincidence. The same archetypes emerging in the same order, shaped by the same kinds of childhood environments, producing the same kinds of adult decisions. He leans in slightly now. What millennials didn't just act young. They were raised differently, more protected, more affirmed, more collectively oriented. That wasn't random. It was a response to the generation that raised them. Boomers projected idealism outward, onto institutions, onto their children. You can see it in the parenting. You can see it in the culture. You can see it in the outcomes. Duffy doesn't interrupt. He waits. Then he picks one thread and pulls. If that's true, why does the data collapse when you control for age? Now the room is with him. Take millennials at 22, he says. Compare them to Gen X at 22 or boomers at 22. Strip away the label. What do you actually see? The same financial instability, the same distrust of institutions, the same experimentation with identity and work. Different tools, same patterns. He pauses just long enough, and when those same millennials turn 35, mortgage, kids, career ladder, they converge. Not perfectly, but consistently. He looks directly across now. If generational identity were as strong as you claim, it wouldn't dissolve that quickly. That lands. Howe smiles, but it's not dismissive, it's recognition. You're measuring snapshots, he says. I'm measuring trajectories. A murmur in the room. You're asking whether people look different at the same age. I'm asking whether they reshape the world as they move through it. Now the energy shifts again, because that's harder to dismiss. The 4th turning, Howe continues, wasn't written after the fact. It was written in 1997, a crisis era beginning roughly 2005 to 2010. Institutional breakdown, financial collapse, civic stress, a generational collision over how to rebuild. He lets the timeline hang there. You can call that coincidence, or you can call it a model that works. Duffy doesn't rush this. He knows the weight of prediction. But prediction alone isn't proof. Astrology predicts things too, he says quietly. So do simple trend extrapolations. The question isn't whether a model can describe the past or loosely anticipate the future. It's whether it isolates a real causal mechanism. Now the room tightens again, because this is the crux. When you label something generational, Duffy continues, you're not just describing, you're prescribing. You're telling managers how to hire, governments how to allocate, media how to frame conflict. Gen Z doesn't want to work. Boomers broke the system. These aren't observations, they're shortcuts. And shortcuts scale badly. A few heads nod more firmly now. You turn structural problems, housing, wages, education, into identity conflicts. And once you do that, you stop solving them. That's the cost. Howe doesn't disagree, not fully. Bad use of a model doesn't invalidate the model. His voice is steady, but there's an edge now. The periodic table didn't stop being useful because someone misread it. The question is whether the structure underneath is real. And if it is, ignoring it doesn't make it go away. Now both men are standing still, no gestures, no pacing, just two different lenses locked. Duffy breaks the stillness. Or, the structure you're seeing isn't generational at all. It's institutional. It's technological. It's economic. Different cohorts pass through different systems at different times. That shapes outcomes. But that doesn't mean the cohorts themselves carry some enduring character. He lets that word linger, character, because that's what's really being debated. Not behavior, identity. Howe nods once slightly, and yet the patterns persist. Not perfectly, not mechanically, but enough to prepare for what comes next. Enough to recognize when a society is entering a phase where old institutions fail and new ones are forced into existence. He looks out now, not at Duffy, but past him. If you wait for perfect data, you miss the turn. That line lands harder than anything before it. The room goes quiet again. Not uncertain this time, divided, because both arguments hold. Duffy is right that most generational differences disappear under scrutiny, that people are more similar across time than we admit, that labels flatten complexity and create lazy thinking. Howe is right that history moves in waves, that institutions age, that collective behavior over decades creates patterns you can't see in a single data set. They're not answering the same question. Duffy is asking, are generations meaningfully different from each other right now in measurable ways? Howe is asking, do groups of people, shaped by shared formative conditions, move through history in ways that leave predictable marks? One is cross-sectional, the other is longitudinal. One protects against overgeneralization. The other protects against short-term blindness. And somewhere between those two is the actual world, which leaves the audience with an uncomfortable truth. If you think in generations, you risk turning people into stereotypes. If you refuse to, you risk missing the structure shaping everything around them. And in markets and policy and culture, mistaking the level of the game you're playing is usually more expensive than being wrong inside it. And that is the greater debate.
Let's invent again. The year is 1840. America is in a frenzy of expansion. The Erie Canal has connected the Great Lakes to the Hudson River. The railroads are following. Commerce is moving inland for the first time in the nation's history, and everything is moving across bridges. The problem is the bridges are made of wood. Wood rots, wood burns, wood bows under loads it wasn't calculated to carry. Engineers were building by feel, by reputation, by rules of thumb passed from one master builder to the next. There was no math, there was no science, there was just experience, and experience was frequently wrong when the loads got heavy enough. Squire Whipple was not the most famous engineer of his era. He worked at the Baltimore and Ohio Railroad and the New York and Erie, doing ordinary technical work on ordinary projects. He was not a celebrity. He was a man who read the problem precisely. His insight, developed over years and patented in 1841, was deceptively simple. Different materials carry different kinds of stress. Cast iron handles compression, push forces, things being squeezed. Wrought iron handles tension, pull forces, things being stretched. A bridge is both at once. The bottom chord is under tension, the top chord is under compression. Previous designers used one material for everything, which meant either wasting expensive wrought iron on parts that didn't need it, or risking failure from cast iron in parts that would be pulled rather than pushed. Whipple used each material for exactly what it was good at, and nothing else. Over the next 2 decades, more than 100 iron bridges built to his designs spanned the Erie Canal and the rail lines crossing upstate New York. But the deeper invention was intellectual. In 1853, Whipple published a work called A Work on Bridge Building, the first scientific treatise in American history to provide a mathematical basis for calculating stresses in structural members. Before this book, bridge engineering was a craft. After it, bridge engineering was a science. Engineers could now calculate whether a bridge would hold before it was built. They could design at scale without gambling on intuition. He's known today as the father of iron bridge building in America. But the thing worth understanding is what happened after. The mathematical framework Whipple created didn't just improve bridges. It created the template for structural engineering as a discipline. It let the railroads expand faster. bridge wider rivers, carry heavier trains, and those railroads define the economic geography of the United States for the next 80 years. The physical infrastructure of a continent, where industry clustered, where cities grew, where labor moved, flowed downstream from a man in upstate New York who asked, "What is this material actually good at, and am I using it that way?" The connection to this week is direct. The AI energy breakthrough we covered earlier is exactly the same move. Neurosymbolic AI doesn't try to solve every problem the same way. It uses neural networks, where neural networks are strong, pattern recognition, statistical inference, and it uses symbolic reasoning, where symbolic reasoning is strong. Causality, step-by-step logic. Two different materials, two different kinds of stress. Same insight. Use each for what it's good at. Squire Whipple didn't just build better bridges. He showed us what it looks like when first principles replace rules of thumb. You get 100 bridges across the Erie Canal. You get the American Railway Network. You get a continent connected by iron that was put in exactly the right place, doing exactly the right job. First principles are never glamorous. They're almost always quiet, and they tend to show up before the future does. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the arc. From neurosymbolic AI to Squire Whipple's iron truss, from tax-free municipal bonds to whether generational theory is science or astrology. And the pattern was simple. Use the right tool for the right stress. Because first principles are rarely flashy, but they are usually where the future first becomes visible.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you, to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, agentweekly.ai.
Until next time, stay curious.
Stay kind.
And keep compounding.